Hi, welcome back to our channel. So in this video, we will show you how options actually work in the market with the help of some clips which we recorded in the first week of February. It was also the week where budget was announced. Budget was on the 1st February, so markets were quite active and volatile. This video clip was recorded on 31st January, which was a Monday. And all the positions were taken at the end of the previous trading day. As you can see on the screen, all the options have an expiry of 3rd Feb, that is the Thursday of the first week of Feb. I will be using some derivative market terminologies in this video. So if you don't know the basic terminologies, then you can go and watch our previous videos. So when we took the positions, Nifty was trading at 17,100. And when the market opened on Monday, it opened 200 points higher and Nifty had crossed 17,300 levels. So on the screen you can see we have shorted 15,650, 16,200 and 16,300 put options. These options are far out of the money options. That means if Nifty does not go below these levels, then these lots will go to zero on Thursday. That is the expiry. Same way, we have shorted 18,400, 18,300, 18,100 of call options, which will go to zero if Nifty does not go above the level. So here basically if Nifty stays in the range of 18,100 and 16,300, we will get all the value left on each of these lots. Now in the middle you can see we have bought 17,100 call and 17,050 put options. We had bought this when Nifty was trading at around 17,100 level. Now since Nifty has moved 200 points higher from that point where we had bought these options, you can see that 17,100 call option is in profit and 17,050 put option is in a loss. But now since market has crossed the level of 17,100, 17,100 options are in the market and intrinsic value will get added to it. These buying positions are also acting like hedges for the options that are shorted. Since more the market goes on one side, the profit of the buying positions will cover the losses of the short positions. The prices of the short positions will increase as the market moves closer to their strike price. But since we have taken buying position that is at the market, it will increase at a faster pace than far out of the money options that we have shorted. Now, on the next day, as you can see, the Nifty has crossed the levels of 17,500 and all the call options are in negative and all the put options are in positive. We bought more 100 units of put and call options. So now the total buying positions are 400 on calls and 400 on put. We did this to match the delta with the short options. Delta is basically how much will the premium move for 1 point of movement in the Nifty. We will explain about the Greeks in detail in the coming videos. You can see 17,100 is on 480. That is due to the fact that it is above its strike price and the intrinsic value is getting added to it. After this, we booked the profit on 15,650 and 16,200 so that we can move it closer and shorted 16,600. Since the Nifty has moved almost 400 points upward from the time we first took these positions. As the Nifty was moving upwards, we decided to book the profits on 16,300 and moved it to 16,700 put. After this, the budget day was coming to an end and we decided to book the profits on the buying positions that were bought in the beginning. After this, we booked the profit on 16,300 and 16,700 puts and moved it to 17,000, 16,900 and 16,800. Similarly, we booked the profit on 18,400 and 18,300 and moved it to 18,100. Since the degradation had kicked in as it was an end of Tuesday and expiry was just 2 days away. Also, the India VIX had dropped since the budget day was almost coming to an end. India VIX basically shows you the volatility of the market, which fluctuates based on the number of orders coming in the market. When the VIX drops, the premiums of the option lots also drop. So, on the next day, you can see the Nifty had moved even higher and crossed the levels of 17,750. So, we booked all the put options that we had shorted previous day and shifted it to 17,200 and 17,350. And we booked half of 18,100 call options and moved it to 18,050. After this, the market remained flat on Wednesday and we could eat up all the points left on the put option. On Thursday, that was the expiry day, there were hardly any premiums left on the lots. So we decided to move it to 17,850 call option and 17,550 put option and eat up the last bit of premiums that were left. After eating up the last bit of premium on Thursday, the total profit we managed to take out was 82,000 in that week. We had to pay a brokerage of around 2,800 and the net realized profit was 79,200. This is how non-directional trading in options work, and it's called as options writing. Just a disclaimer, do not go for options writing without having complete knowledge and information about it.